Good evening, everyone. It's Brian Ponder, Brian the credit lawyer. I call myself the credit lawyer because my practice is based in consumer law. I handle credit, debt, and real estate litigation. And tonight we have a very action-packed Zoom. We're going to talk about the top 10 financial to-do list in the COVID-19 era. And tonight we have some special guests, some experts that we're going to hear from. And it's going to be a treat for you all tonight. We have about 15 people. It's great crowd. Everyone should be muted as you enter the room. If you want to put a face with your name, you can activate your camera. You certainly don't have to. When you have a question, you can unmute yourself at any time and ask your question. Don't worry about interrupting the flow, because guess what? I have notes. You're not going to throw me off. So at any time you have any question, comment, you can interject and let's talk about it. But you will have to unmute yourself to do that. So with that being said, we're going to jump right into it. Now, we're doing tonight because we are in what we call the COVID-19 era. We're faced with a pandemic. It has changed our way of life. It has changed economics. And I think it's important we go through a top 10 to-do list while we're still relatively early in this pandemic so that we can be proactive versus reactive. I'm actually going to share a presentation with you. And let me go ahead and do that now. Share my screen. Actually, you know what? Let's see, where's the desktop one? Hold on. Hold on. We will share desktop too. 1 second. We'll just share desktop too. How about that? We're going to share desktop too. All right. All right. Can y'all see my presentation screen here? Let me let's let everybody in that wants to get in. All right, good. So y'all can see. Let me make sure I got my comments. I can see your comments. Okay. All right. So the top 10 financial to-do lists in the COVID-19 era. Number 1 on my to-do list, earn income. What I mean by that, obviously, is if you're working, you want to be earning income. You also want to be thinking about your plan B. Your plan B is your secondary source of income. You want to, right now, you want to just accumulate as much cash as possible. Got a few people still coming in. And if you're in business, you want to just get all the cash you can right now if you're still in business. Number 2, you want to save income. So those of you that are still earning income, you really want to accumulate as much of it as possible. You don't know what next month is going to bring. You don't know what the next, quarter is going to bring. You want to save by budgeting. So now more than ever, a lot of people, just live without budgeting. You want to budget. You want to cut costs. A lot of you have been forced to cut costs because you can't eat out as much as you used to, but you want to cut costs all the way around, anywhere you can. If you have cable, you might want to reduce it from all the premium, everything. You want to get the best gas price. People are able to save right now on some of their recurring costs, such as the mortgage. You might want to get that extended. If you're in repayment of your student loans, you may want to defer that. You want to cut all costs. Anything you're spending money on, you want to look at it and see if you can cut some costs. You want to also downsize. So if you're living above your means, this is a great time to go ahead and downsize while you can do that. You want to either buy or refi. Now we have Mr. Jamar Bates, who's going to come on in just a second. He's going to talk to us. A few things have changed with respect to buy or refi. Why do you want to buy or refi in a time like this? Well, guess what? Rent is high. And remember, we're trying to cut costs. You could buy and your mortgage will be significantly lower than rent. The interest rates are low. So Mr. Bates is going to talk about that. If you already have a house and have a mortgage, this is a great time to lower your payment by refi. Remember, that's going to cut costs. So we're going to talk about that. You're going to have all these assets. This is a great time to plan with life insurance. If you have children, you have a spouse, anyone that depends on you financially, well, now more than ever, you want to go ahead and secure them and each other with some term whole life insurance, life insurance, okay? We're going to talk about that in more detail. We're going to talk about how much life insurance do you actually need. You want to draft, number 5, you want to draft or update your will or get a trust depending on your needs. You want to have an attorney draft or review that. Why? You can go online and get wills. Well, a lot of you may be aware, these wills, when someone passes and their estate, is going through probate, all kind of things can come up. You can, fight, disputes. Well, you can prevent a lot of that by having an attorney draft or review it to make sure that it's legally sound. Everything you find on the internet may not be proper. You want to make sure it's done right. You can get a legal plan, make it very inexpensive. It doesn't have to be expensive. If you don't have or want to get a legal plan, you can retain an estate lawyer to get that done. Number 6, you want to improve your credit. That's going to be very important if you're going to buy or refi, right? That's going to also be very important if you want to establish business credit. As you establish business credit, it's going to be based on your personal credit to start. It's not going to go on your personal credit, but at first, until you get a matured business credit, it's going to be based on your credit. So you want to improve your credit, and we're going to talk more about that in more detail at the very end. Believe it or not, life insurance is based on credit. There's something called a Medical Information Bureau, MIB. So a lot of you don't realize you have a credit report that can affect your ability to get life insurance and your rates at life insurance. Number 7, I suggest you learn and buy stocks. There are several ways you can do it right now. There's an app called Robinhood that makes it real easy. They advertise themselves to be commission free. Most favorably, when you join, I'll share a link with you later, you'll get a free stock. So as you tell other people about it, you're going to get free stock. And so you get a chance to learn, how to watch stock grow. And but most of all, you want to get the proper education and learn how to trade stocks so that you're mitigating your loss and risk level. So you want to get education on that. Now, number 8, I recommend you start businesses. And yes, I put a plural on that because you're going to find, we talked about personal credit. The whole reason of credit is so you have access to capital. Well, personally, you can only access so much capital based on your personal income. With a business, it's much different. You can access perhaps $250,000 with a good business credit rating and a personal credit rating, whereas personally, you may be able to only access half of that. So when you create a business, you're creating an artificial person. You're a natural person. So when in creating a business, you're creating it's like creating a whole new you, but it's bigger. A business is way bigger than a person on paper. And so you can actually leverage and have access to more capital by creating and developing businesses and their credit rating. You don't have to have 8 different businesses that you're working, but you're building that business as an entity and a credit vehicle so you can have access to capital. You want as much access to capital as possible, because with this economy turning, you're going to be able to take advantage of different opportunities if you have the proper capital. To start a business is not hard at all. You can file your documents right on the Secretary of State's website, get an EIN from the IRS's website. Again, very important that you discuss this with your CPA or attorney to make sure you're getting the right business entity in the election. Number 9, you want to master your industry if you're employed. If you're employed right now, that means you are either what they call an essential business, or you've been resistant to the business closures that have happened right now. So you're in a very fortunate position if you're still employed right now. So whatever you're doing, you want to master it. Why? Because it's your lifeline right now. So you want to put in those hours. Now is not the time to take breaks. You want to put in those hours. You want to advance yourself in your industry as much as possible. Very important right now. Number 10, you want to read, study, view self-improvement and motivational material. Let me okay. Why? Your mindset is very, very important right now. This is one of the first things you want to do, is to get your focus right, get your mindset right. A lot of people are focusing or tend to focus on what they can't do or what's bad happening to them. That is not the positive way to be. You're going to have to reset. I'm going to send you some books, some suggestions on how to reset your mindset and mentality. You're going to find that to be probably the most important thing that you're going to do. To facilitate that, you're going to have to detach from people, not all the time, but for a period of time each day as you focus on your self-study. You're going to also have to detach from social media and TV. Whether it's an hour or 2 a day, you're going to have to do that. It's not a lot of time, but the benefit of that detachment and focus is going to make a huge difference in setting up your mindset. All right. And finally, we're going to go back. We're going to talk about, you remember our number 3 tip was to buy or refi. So we want to talk to Mr. Jamar Bates. Jamar Bates is the CEO of Bates Mortgage Group, LLC. He's a United States Marine Corps veteran, honorably discharged after 8 years. He served in Desert Storm, Desert Shield in the Middle East, Operation Sharp Edge in Liberia, and more. He's licensed to do loans and refinances in over 22 states. And he's the only African-American owned mortgage lender in the country. So it's really a pleasure to be able to speak to Mr. Bates. And Mr. Bates, are you with us here? How you guys see you there? Unmute you.
Okay. Yeah, I'm muted. Hey, I appreciate it. And thank you for the introduction, Brian.
Oh, my pleasure, Bates. Please talk to us about why it's important. Was I correct? Is it a good time? I mean, people can be buying and paying less in a mortgage than their rent, and we're trying to cut costs right now, right?
Yeah, exactly. So a couple great points. So, so many different points. I'm actually making notes myself based on some of the information you shared so that I can kind of touch on some of the juicy parts here. So one of the things that people don't realize is that with mortgages, one of the main things that we look at is the client's ability to repay, right? So in terms of that, we're looking at what I call the 4 C's, making sure the client has cash, credit, capacity, and circumstances. And that's just for the financing piece. The ability to repay talks about making sure that if we're going to loan you that money, that we know that you have a means to pay us back. That means could be either from earned income or from passive income, such as disability, pension, rental properties, things of that nature.
Mm-hmm.
What we're seeing in the market now is a matter of our underwriters, either the day before closing, they're making sure that you have not been furloughed, put on leave, or anything else if you're either going to purchase or refinance. Now, if you do have a W-2 job, then that's the challenge that you may deal with in terms of saying, hey, I own this property and I've had it for several years, but my cash flow may not have the 3 to 6 months of reserves or 12 months, but you have a lot of equity in your home. But if we as a lender can't verify we're going to be able to, your ability to repay, we won't move forward with the loan. So now that $50,000, $100,000 or whatever that equity is in your property, it's just locked up. It's phantom money versus cashing out and having that cash in your pocket. Now, a few of the things they've changed in terms of the guidelines to get financing. One is what we call loan to value. So on a refinance, the loan to value it used to be about 90%. It's now dropped to about 80%. And if it's a cash out refinance, then it could go somewhere between 75 and 80%, meaning you have to have at least 25% equity in the property for us to do that loan on a cash out refinance. They've also increased the minimum credit score. Previously, you can finance a home with a 580 credit score on FHA, 620 on conventional. Now those numbers have jumped up to 640 and 660 based on which lender or investor you're dealing with. So it's more higher credit, lower loan to value. So they're being more conservative in terms of the money or the people that they're lending the money to. Another thing in terms of the beauty is not only getting the cash out. I just refinanced a client last Saturday before last, 3-day right of rescission.
Mm-hmm.
So it consummated on Wednesday. He was able to skip his April payment and skip his May payment. Normally, you only get to skip one payment. We're able to facilitate it where he skipped 2 payments. The house was about $482,000, so he's saving about $2,800 a month for 2 months. So that's
wow.
Saved. Not including, we set up another escrow account for this client, and now he's getting about a $6,000 refund from the escrow funds that were in his account.
Wow.
So he's getting a $6,000 check back. His interest rate was reduced by almost 1%, and he gets to skip 2 months of payments at $2,800. So about a $12,000 swing, if that helps any clients that you may be working with.
Absolutely, absolutely. Well, from what I'm hearing from you, Bates, if anyone is on the line of, I'm thinking about buying, this is a great time for that reason you just stated. And, we don't know what the future holds, right? As far as being furloughed or anything else, you want to get into that property now while you have that income, because you never know next quarter if you can even have a job.
Correct.
Right. Okay. We had a couple of questions, Bates. Do information bureaus affect you to be approved for mortgage? Now, information bureaus, I don't know if they're talking about maybe credit.
Yeah. So I would assume that's the credit bureau. Do they affect your being approved for mortgages? So they do not. So credit bureaus, it's 3 main repositories: Equifax, TransUnion, and Experian.
Mm-hmm.
So they are only relaying the information that's coming from your creditors. So that information may not always be correct. So there could be erroneous information. Balances may be lower or higher when we pull the credit than what is seen at the time. So we base our information off of the information that we're getting from those credit bureaus. A good loan officer will share that information with you so you can make those corrections.
Mm-hmm.
But and again, it's kind of vague because it's saying information bureaus versus credit bureaus.
Mm-hmm.
It may affect you to be approved for mortgages. Ultimately, it is the lender who makes the decisions. We can go down to, prior to the COVID-19, we were able to go down to almost 500 credit scores. Now, keep in mind, the lower the score, the more you may have to put in terms of down payment, right? Because somewhere in that 500 to 580 credit score, we know there's been either bankruptcy, foreclosure, lien, judgment collection, or a bunch of lates. So you have to pay. Either you're going to pay now or you're going to pay later, but you always pay for that indiscretion. Ultimately, it is the lender or the mortgage company who makes that decision based on the risk that they're taking of the money that they're lending you as the borrower.
Okay, awesome, Bates. We have a couple more questions. Did the scores go up for the USDA loans and also for the VA loans? That's the question right now.
So the question, so it's always been 620 for USDA loans. There are a couple lenders out there who are taking on that additional risk. I do have a lender or an investor who is still dealing with 580 credit scores for FHA. It's not anyone that I would do business with because of the subprime and the way their underwriting is. Mm-hmm. But there are some who are still out there willing to take the risk because VA has minimum guidelines. Actually, VA does not require a credit score, but it is the lender who assesses what minimum credit score that they'll take for that risk. So in terms of going up, VA was able to go down to 550 with some lenders. Mm-hmm. Some banks, they won't take it less than 660. So depends in terms of what you thought the initial score was. And yes, I am licensed in Texas. And can I go over their interest rates for refinancing 15 and 30-year fixed? It's challenging to go over interest rates because there's so many different dynamics. Mm-hmm. Your 15-year interest rates will always be lower than the 30, but the payment's going to be higher because you're paying off that same amount in pretty much half the time. It could be advantageous. What I do tell clients is go with the 30-year loan, and that way you have a lower monthly payment. So in times like this, if your funds were tight, you always have the option to pay more on your loan, right? So if you have a 30-year loan and the payment's $2,000 a month, but you want to pay an extra $1,000, you can pay that to the principal only. Mm-hmm. But if you get laid off from your job or things get tight, you don't have to pay $3,000 a month. You can just pay the lesser amount of the $2,000 and still keep your payments on point. So interest rates, when people ask me rates, it can always vary. I don't know if you have a 550, 650, or 750, or 800 credit score.
Sure.
Is it going to be a primary, investment, or second home? Is it an FHA or conventional? So it's about 5 or 6 different dynamics that we have to look at to basically be able to start figuring out which product or program is best for you to get financing in place.
Okay.
Oh, thanks. So yeah, those are the 23 states that we're licensed in. Those are all listed at batesmortgage.com. Someone asked about Tennessee or Texas and Florida. We are licensed there, and we're not in Mississippi.
Okay. Let's see. Do we have any other questions showing up there? Let me stop that share.
And you also mentioned something about business credit. I'd love to jump back in and chime on that when time permits.
Please do. And thanks, Bates. Yeah, please do jump into about that.
Okay, so great thing in terms of business credit, right? So I had a client of mine probably a year ago looking to purchase a home, and she was self-employed. So this only works for someone who's self-employed. She had about a 705 credit score, but her taxes showed that she had about a $30,000 debt or $30,000 of taxes that were owed. So we have to pay off any federal taxes or have a payment arrangement. So instead of her using her cash, because she was a veteran, so we were doing a VA loan,
Mm-hmm.
She can't go and take out a loan because that's going to affect her debt to income ratio. So it was 3 different types of cards, either a Capital One, Chase, and American Express. They can both issue about $20,000 to $30,000 line of credit. With business credit cards, it does not go on your personal credit.
Right.
So normally on your personal credit, you want to keep your debt to credit ratio below 30%. So if you have a $10,000 credit card, in terms of the high credit limit, you don't want to go over about $3,000 per month. Now, what is key, and a lot of people don't understand, is you have to find out with each creditor or credit card that you're paying, what date they report to the bureau. So just because you want to pay end of the month, that card may not report until the 10th of the month.
That's right.
So that's the date you want to look at to make sure that your balance remains below that 30%. So it's not always just paying at end of the month or when the statement's due. It's about finding out when they pay that. So she was able to get an American Express credit card in her business name, never shows up on her personal credit.
Wow.
You can use that amount. You can use that now. With American Express, we got our platinum card. The first $35,000 could be paid over time. So it's not always a matter of it's an American Express, I got to pay that bill in full at the end of the month.
Gotcha.
So a great way for you to transfer debt from your personal credit into your business credit. No one ever sees how much debt you're carrying on your business credit. Now, even though you're a personal guarantor, should you fail to make payments, then after 3 payments, it will transfer over onto your personal credit. But it's just a great way to move money there.
Awesome. Awesome. That's some good information. Yeah, we appreciate that. Yeah, that's very important. I mean, a lot of people don't, realize that. So that's awesome, Bates. And again, can you tell them how they could contact you? We see you're in many states, so how they would reach out to you to get a mortgage or buy a refi?
Sure. So you can go to batesmortgage.com, Bates like Norman. Easy way for folks to remember that. batesmortgage.com. And at the bottom of the webpage is my contact information, email. You can text me or call me for any comments, questions, or concerns you may have. Relatively new startup. I've only been doing this for about 20 years. So I can help you out. I do have other businesses. So if you have business questions that I can be of any help, value to, talk about QuickBooks. When you talk business, when you talk money, back-end systems, I love it. Could talk about it all day.
Awesome.
And I'm a steal one other session or
yes.
second from you there.
Yes.
You talked about mindset, right?
Please.
So even from a business mindset, that's why I love talking business. People overestimate what they can do in 1 year and underestimate what they can do in 3 to 5 years. So all the planning I look at is like that 3 to 5 year planning. And I'm not sure if you've had this call before, if this is like the first time, but anyone out there who's either in business, looking to talk business, I'm here all day and half the night.
Oh man, that's awesome. And we got one more question for you. And if you can hang around, that would be great. But we have at least one more question for you about Chase. Is it true that Chase wants a 700 score and 20% down?
Yeah, so those are the old school conventional loans that people had to deal with for years until some of the new guidelines came out. But yeah, effective tomorrow, Chase is asking for, and I had it on my webpage, 700 credit score, 20% down, as again, they're mitigating risk in terms of the market. So they want to make sure that you have a loan history of payment, or paying on time, which is what that 700 score is, and that you have skin in the game. But that's just Chase, and other lenders don't have those same requirements. Most are going to have less than that, but that's kind of where the market's going.
Okay. And James P., I'll unmute you. Go right ahead, James.
Thank you, Brian. This question is for Jamar. Jamar, I have a question as a seasoned mortgage professional that you are. How are you guys handling the EPOs and EPDs right now?
In terms of you talking early payoffs?
Early payoffs and early pay defaults, let's say you just funded a loan like in January and the client gets, sees, headlines, hey, no payment till, for the next 12 months. How's it affecting your branch and LOs?
So in terms of our branch, we still adhere to the early payoffs. There have been no additional guidelines there. So my company is pretty much a hybrid. It sounds like you're in the mortgage industry.
Yes.
Okay, so our company is pretty much a hybrid. I'm a non-delegated correspondent lender. So we have the ability to select either if we want to put that on my warehouse line, or if we just want to broker it out and not take that risk. If they were brokered out, then it's nothing for us to be concerned with. We got our commission at the close, but on the correspondent line, early payoffs, they actually will pay the difference in terms of what that early payoff is.
What's your chargeback period?
Our chargeback period is 12 months.
12 months, wow.
I do have a investor, actually the one that I mentioned before that goes down to 580, Barrington Mortgage. They don't have an early payoff.
They just haven't, they haven't been hit with the margin call just yet, probably.
Correct. So so previously I have had clients who were looking to refinance the property, get cash out, and then purchase another property. But they told us, look, once I refinance, I'm looking to sell it. So because they disclosed that to us up front, we let them, that was the decision for us to take it to Carrington, because we knew we could still do the deal and not be hit with an early payoff.
Right. I think, in the mortgage space and credit space, we should be educating consumers with the new lending landscape and prepare them for exactly like what's happening, the higher score requirement, the bigger down payment, and also letting them know the damage that can happen by placing your loan in either a forbearance or a deferment. I don't know if you read PennyMac is if you did a deferment, the big servicers will probably, if they see that on a credit report, they will probably, you'll never be able to they'll never take you on as a client.
Yeah, so they do have, I was speaking with another buddy of mine in the commercial space, and he said some of the conversation with them were the same in terms of it's not an official set of books, but they actually will note those accounts that are taking the deferment or forbearance.
Yeah, it's not good. Thank you. That was my question.
Okay.
Well, we appreciate that, Bates. Like I said, if you want to hang around, we're going to talk some life insurance. I know you have a wealth of experience in that. We're going to have Avery talk a little bit, and I think you may have a lot to chime in there as well. So if you can hang around, that'd be great. And see, and Avery.
Yes, sir. Can you hear me?
Yes, sir. Can we let me actually just share. We have you here. Does everyone see your information? You're a financial services professional, and looks like you're available. We can book a session with you and talk to you at any time.
That's right.
According to your calendar.
With the COVID virus, I have a lot of time on my hands, I tell you.
Absolutely. So look, we had a discussion online the other day. I have some provocative topics. The topic was, if you are married or have children, if you don't have life insurance, do you really care for them?
I saw that.
And got a lot of answers, a lot of roundabout answers. A lot of people got offended. I don't know what's offensive about it. It's just a question. But what I was really trying to get at is, if you do care for them, you can only care for them, I guess, if you're alive and well.
Absolutely.
And if you're not alive and well, what happens? You got a big mortgage, you got a whole lifestyle, you got college, you got bills that will continue for your loved ones.
That's right.
So if you do care for them, if you can't any longer, what happens to them? I mean, do you just care for a short period of time? So anyway, I wanted to open that discussion up. Can you tell us just in basics, and I also had someone that said she didn't know about what life insurance was until she was 30 years old. And I believe that young lady may have like a 10 or 12-year-old child. So can you just tell us what life insurance is to start, and then the types of them, just to lay the foundation?
Yeah, unfortunately, because of our background, I hate to talk like this, but it's a culture. In different cultures, they praise insurance. Like from day one, and they talk insurance and talk insurance. In primarily the African American community, we don't really know about that for the most part. Now, of course, I know a lot of my friends that went to private schools. Of course, their parents would tell them about it, but for the most part, as a general, that's not our, that's not our thing. We don't really know about that. So,
What
the
is
law,
life insurance and how does it work?
life insurance is basically it's very simple, and it's basically you are putting money away each month. So just in case something happens to you, death, accidents, whatever, you will have money set aside to take care of yourself. So,
And Avery, let me stop you there. I used to say the same thing. I used to use that 2-letter word myself until my friends told me, if. It's no if, it's when.
yeah, it's when. It's
Okay.
when.
Mm-hmm.
Yeah. So this is the situation. If you're married and you have kids, you should have insurance. Now, most people either don't have insurance, or are underinsured.
Why should they have insurance? I mean,
They should
why?
have insurance because it's very simple. If you're married and let's say you're married and you have 2 kids, and let's say you make $100,000 a year and your wife makes $50,000 a year, and you have 2 kids, right? Well, you probably have a $250,000 mortgage. You probably have 2 cars that you're paying on, a private school, what have you. Now, if something happens to you, I make $100,000, right?
Mm-hmm.
What's going to happen to your wife when that $100,000 is gone?
Mm-hmm.
How's she going to pay the mortgage? How's she going to pay for private school? We have to think about these things. So if she dies and she's making $50,000, how's he going to supplement that $50,000? So
if she dies first.
So what we do is we do a fact finder. Me and Bates were talking about that earlier today. We have to do an intensified fact finder. You just can't come up with a number and say, okay, I need 100,000 or I need $500,000. Now, from what I have been seeing with average income, most people have at least $1 million in debt.
So that's the base. That means that's just enough to cover debt.
So now we're talking about $1 million for you if you make 100,000, and maybe another $1 million for your wife. So you might need $2 million. It all depends on what your debt is. It's not a cookie cutter situation. You have to really sit down and break down your debt, your monthly bills, and different things like that. So when I meet with you on the phone, the first thing we talk about is basically, what is your strategy? What are you trying to do? Are you trying to save money, whole life, or are you just trying to position yourself where you can take care of your family? What I like to do is a blended strategy where we're doing some term, some whole life. Now, what is term? Term is insurance that is for a particular set of time. So you can do a 1-year term, 5-year term, 10-year term, 20-year term. It all depends on what your strategy is. We sit down and we talk with you and you're trying to figure out what your strategy is, right? Now, let's say you do a 20-year term, but you live past 20 years. You lose that money. Now, if you don't make it, then guess what? It goes to your beneficiary. Now, in this time of unsettled with COVID-19, you really need to have a couple beneficiaries. Most people put their wives, then their mom. You need about 3 of them, 3 or 4.
Sure.
Because what you don't want to do is have the state handle your insurance. And now,
Avery, when you say 3 or 4, are you talking about in the event that the one you want is deceased with you or predeceases you?
Yes.
So that it's okay. Or you could have several. You can name one policy.
Yes. So you have one, it might be your wife. Then if something happens to her, then it'll be your mom.
Someone else.
Then someone else, whoever. You need to have that layer. Because
go ahead.
Go ahead. Yeah, because if something happens to you, and let's say you have $1 million policy, well, your beneficiary gets to have that money in a lump sum without any tax issues. If the beneficiary is not in place, then it's going to be a problem. Then that's when, you know, the government gets in your business and you get taxed and different things like that.
And
so,
Avery, before we get to questions, which we have about 3 at least,
okay.
Can you describe term, can you describe whole life insurance for us?
So now, whole life, I like. Okay, let me just say this. A lot of people think they can't afford term. They can't afford insurance. So first thing I say is get term. You can get term for as little as $20 a month. So whoever's saying that they can't afford term, they really don't understand how it works. Insurance is not expensive. There's different types of insurance. You can have expensive insurance, but you can have inexpensive insurance as well. But the main thing is to have insurance, because what we don't want is people doing GoFundMe events for you, and you're a grown person. That's not a good look. So, I mean, you can literally get $100,000 in term for less than $20 a month, depending on, and this is what you're talking about, the MIB, your age and your health. They do a risk assessment on you, and then they rate you. It's like having a 800 credit score and a 500 credit score. A 800 credit score would be a preferred rating, and a 500 credit score would be like a smoker.
Okay. And what is whole life insurance? What is whole life insurance, if you were to
whole life
tell someone?
insurance is basically, it's insurance that it's called permanent life. So it lasts you for the rest of your life. So term is for term. Whole life, it lasts you for however long you live. You'll have a death benefit, right? But it also comes with a savings component. So every time you put a payment in, it's building a cash value as well.
Mm-hmm.
So the reason why people like whole life is because if you've been paying on a policy for 20 years, you built up a lot of cash, and if something happens where you need to pull some of that cash out, you can pull it out with very little penalty. It's like you're getting a loan from your policy.
Okay.
So
awesome.
A lot of people like that because, let's be honest, most people can't save.
Right.
So I have clients that are aggressively, spending $500 a month on this whole life policy because sometimes it's hard for them to save that kind of money. So it kind of kills two birds with one stone. You can save money, and the beautiful thing about it is it's creating interest. You earn interest as well. So
okay.
whole life is way better than. This is why wealthy people use it, because in a traditional banking system, you're going to only get probably 0.5% interest, whereas whole life, most other companies will give you 3% minimum.
Okay.
So it's a good way to save money and have a death benefit at the same time. It's more expensive than term, but a good way to start would be term, and then most term policies can be converted. So you can convert. So let's say you get a $1 million term, right? Well, you could take 300,000 of that and convert it to whole life. So in other words, you convert 300,000, and then you have 700,000 left in your term. That's that blend I was talking about.
Okay.
A blended attack on whatever your goals may be, and your goals it all goes with your fact finder to find out, what bills you have, private school, travel, a fund, whatever. All that needs to be put into the pot, and then we calculate exactly how much coverage you need, and then we reverse engineer based off of that, because most people can't afford $2 million in whole life.
Awesome. Okay.
That's going to be expensive. But what you can afford is $3 million in term, and maybe $500,000 in whole life.
Got it.
It all depends on your age and your health rate.
You can mix it up. So you can mix up the types of policies according to your financial situation.
Correct.
Okay. Well,
absolutely.
Avery, what I did, we have 10 minutes for questions, and I went ahead. If someone wants to contact you, I put your contact link in the comments. And for these 10 minutes, I know you and Bates have insurance knowledge here. So I'm gonna open it up to you and Bates on these questions. I'm gonna unmute you, Bates. And the first question I see is our statement: your children are not your retirement plan. At least leave them with enough to properly bury you. Well,
that's very true. And what I would suggest, you know, they have a term called $1 million baby policy, right? So basically, a lot of these companies, as long as the baby's 4 days old, you can actually get a policy on them. It's very inexpensive, and your grandparents can pay for it. You can pay for it. Uncles can pay for it, and basically, it's a whole life policy, and it's a permanent insurance policy, and you pay on it for anywhere between 17 and 20 years. After you pay, by the time they're 20 years old, the policy will be paid off.
Wow.
And it'll be making money. So by the time they are 65 years old, depending on the amount that you pay, they can really be a millionaire. That's how you can create a millionaire. That's how you can make your children a legacy by investing in them when they're born.
Right.
You know.
Very
but
good.
the good thing about it is, a lot of these companies will allow you to control the actual disbursement of the money. So in other words, when they turn some companies, when they turn 18, you lose control over the money. So they actually get the money at 18. You don't want that.
That's the value of the will part as well. So
say it again, right?
I said that's the great part in terms of having a will, because
yes,
with the death benefit that is tax-free, with the will that's properly structured, you may not want to give $1 million to an 18 or 20-year-old. So as Brian mentioned earlier, you can have the will say, well, we're going to distribute X amount of dollars each year until the child is 21, and they get a lump sum. At 25, they get another lump sum, and at 30, they get the balance of the money in the account. But great points that you mentioned, Avery. And as I always looked at it, life insurance, there are three main reasons I would talk to a client about having life insurance. One is to make sure you pay off your debt. So when I'm working with clients, and I see it from both sides, because when I'm doing the loan, I can see all the debt they're carrying. So I may say, look, let's make sure you don't leave any debt behind, right? So if that house is $200,000-300,000, they have some student loans, some cars, let's figure out what that amount is and make sure that we leave those loved ones debt-free. The second reason is we want to replace that income. So you kind of look at what your income is, what either that spouse, that mate, or the children may be. And even though you may be leaving them with a parent or a family member, you want to make sure that, yeah, the house is paid off, but it's still going to take X amount of money per month to raise that child for X amount of years. And then the third reason is to actually fund education. So pay off debt, replace your income, and then possibly pay for education or some portion thereof. I have had clients where they may want to leave some money to a certain charity, fraternity, or sorority. But again, those are the three main reasons. So I always say, let's get the dollar amount right for whatever you find to be of value. Reverse engineering, as Avery said, money is only an issue in the absence of value. So first you want to find out, what do they value? Is it even important for them to leave their family debt-free, to replace the income? And that's how I normally start the conversation off in that facet, in terms of find out what's important and also letting them know what life insurance is, what it does, and how it could be a benefit to their family.
What about universal life insurance? Someone asked.
So universal life is, I think it's awesome. One of the things I think is great about universal life, right? With any life insurance, either universal life, term, whole life, and it's a couple hybrids out there. Get the dollar amount right first, right? Either term or whole life. Let's make sure that that check that's being cut to them tax-free is the amount that they need. The great thing with universal life is you can put more money into it as a investment vehicle. And in downtime, such as say this month or this quarter, if you don't want to pay the same amount or you don't want to pay a premium, you don't have to. So if you've been funding it for the last 1, 2, 5, or 10 years, then the policy, in terms of the cash value Avery mentioned, the policy that was accumulated in terms of cash inside that policy can pay the monthly premiums. Mm-hmm. But again, you can always overfund that, so it's a great vehicle in terms of setting some money aside.
Excellent. And credit, someone asks, and well, makes a statement and has a question. GoFundMe is the new life insurance. Well, we've seen, well, that's not even, yep. Well, sort of. That's not the case, but
It's not life insurance. And also,
life insurance.
yeah, I mean, life insurance is a great vehicle.
Yeah.
It's an awesome vehicle. And there are some different policies. Even if you're single and you have no one you really care about to leave the money to,
Sure.
there are certain provisions or what we call riders in the business where it can cover your critical and chronic illness, right? So full disclosure, I'm 50 years old. I'm proud of 50, right?
Sure.
But I'm married, no kids. So I do have a policy to leave for the wife. But if it was just me and I was single, now knowing what I know, right? Because once you know, you can't unknow it, and no one else can be responsible.
Right.
To the point where you should, when you know better, you should do better. But there are some provisions in certain policies with critical and chronic care. If I was single and I had no one to leave it to, you can get, say, hypothetically, a $500 or $1 million policy. And if in 5 or 10 years, the doc says, hey, listen, you got some type of chronic illness and you're going to be, dead in 2 or 3 years. I don't have to go into my savings account that may not have $1 million. I can actually use the death benefit from that policy. I have $1 million policy and I need $300,000 because I need a healthcare professional to come to my house that's charging me $5,000 to $8,000 a month for the next 2 or 3 years to make myself comfortable. Those funds are there. So there are some other things there. If you're single, married, if you want to leave the money to someone, you don't, talk to someone like Avery. He has a plethora of products with New York Life that he can sit down and go over those things with you. But it's a lot of other things that's available to you, and it's not just death insurance. So some people do look at life insurance as just death insurance, and I don't want to leave that money behind because I just don't care about anyone like that. There may be some other provisions that may be of value to you as well. And again, money is only an issue in the absence of value.
Bates, that policy you described for the single person that needs that expensive care, what kind of policy would that be where you'd be able to realize that money? Is that a whole policy or can a term do that too?
That policy is
different.
You can either do it as a whole, a term, or universal life.
Oh, okay. Okay.
Yeah. So it comes with a specific carrier. It comes with all three with no additional cost to it.
Got it. Okay. And do you have to have a Series 215, 215 to offer life insurance to customers, someone asked?
I'm not sure what a Series 215 is.
Okay.
I have a life accident, sickness, property casualty, and Series 65. I did have a Series 6, 63, and 7. When I opened up my own firm, I didn't need those any longer, so I combined those all. But no, for the most part, you need a life insurance license to sell life insurance. And you need an actual license. So it's not a matter of I don't have a license, but I'm a consultant.
Oh, okay.
make sure your folks are properly licensed. And that's the question point blank. And if they don't say yes, move on.
Move on.
Absolutely.
Well, look, we have 1 minute. Any final thoughts or questions? No questions here. Avery or Jamar Bates, any final thoughts now that we've sort of went over everything here?
Yeah, I just think that people who do not have insurance should at least get a term policy. That's very, very important.
Absolutely.
They're very inexpensive, and you can convert them to a whole life or universal policy anytime you want to, but just get started with term. It's very important that you do that because the sooner you're going to wish you did it because the younger you are, the less expensive it is. Every year you get older, the premium gets more expensive, and most likely your health is not going to be as good as it was the year before. So don't waste any time. Don't procrastinate. Get in contact with me. Let's talk about it. Let's strategize, and let's get her done.
I appreciate it, Avery. Thank you for your time, Avery. Great information. Jamar Bates, any last words for us?
You mentioned at the beginning about budgeting, cutting costs. And I use a spreadsheet. I also have QuickBooks, but a spreadsheet, simple, easy to do. If I'm going to blank out my personal information. I'm going to send Brian the spreadsheet that I use. And it's really a basic household spreadsheet. If you don't know what your costs are, probably twice as much as you think. Like if you don't know what you were spending going out to eat, food, drink, and beverage, you think it's maybe 100, 200. If you don't know, it's 2 to 3 times as much. So in terms of getting a grasp on your income or your budget, start with a spreadsheet. Even if you go over it, right? If you think it's 200, it's really 400, at least you know. So now you know where you can cut costs in terms of knowing your fixed and your variable expenses. This is something I've used for years. I think it's just a great tool. I'll send a blank one to Brian, and you guys could reach out to him and get a copy of it if you so choose.
I appreciate that, Bates. I appreciate your time, taking out your evening, Bates, and we know how to contact you as well. Thank you very much. Thank you, Avery. Thank you for everyone who participated. We had about 18 people here. Everyone, have a good evening. Stay safe, and God bless America.